Good morning. The Magnificent Seven is no longer a monolith, it is a tale of two architectures. As of this morning, we are seeing a violent bifurcation in capital strategy. On one side, Apple is being rewarded for its asset light. II pivot, incurring a mere $14 billion in CapEx by outsourcing model development. On the other, Amazon and Alphabet have hit a reality wall. The market is no longer pricing speculative potential. It is pricing the immediate cost of the CapEx Gauntlet. We are witnessing the end of blind mania and the start of a clinical, ROI-driven evaluation of the hyperscalers. Let's look at the raw data. The aggregate 2026 infrastructure bill for the primary hyperscalers has reached a staggering $650 billion. Amazon has shocked the street with a $200 billion moonshot. That is $50 billion above consensus and represents an outlay larger than the GDP of Hungary. Alphabet follows at a $185 billion ceiling, effectively doubling its 2025 spend. Microsoft and Meta add another combined $260 billion to the pile. While AWS revenue growth accelerated to 24% with a $142 billion run rate, the CapEx bloat has wiped out $900 billion in market value across the group in just 48 hours as investors reconcile these unprecedented cash flow drains. Looking ahead to 2030, this spending isn't just about capacity, it's about the vertical silicon moat. Amazon's in-house chip business, Trainium and Graviton, has already reached a $10 billion annual run rate. By 2026, vertical integration is the only way to decouple margins from merchant silicon pricing. However, we must address the monetization gap. The recent SaaS apocalypse, where the software index tumbled 13% in a week, suggests that powerful new agentic models from Anthropic and Google are beginning to displace traditional software workflows. The hyperscalers are betting $650 billion that they will own the agents that replace the software. The risk? If the transition from building infrastructure to generating revenue lags, the depreciation hit will be terminal for mid-tier players. The AMZN risk reversal. For the tactical desk, we are identifying a high-conviction buy-the-flush opportunity in Amazon. Despite the 11% post-earnings slide, the AWS backlog has surged 40% to $244 billion. The stock is currently deeply oversold at the $205 level. We recommend a bullish risk reversal. Sell the February 13th $195 puts to harvest the elevated volatility, and use the credit to fund February 27th $225 calls. We are targeting a technical gap fill toward the $250 resistance zone as the initial shock of the CapEx guidance subsides and institutional dip buyers rotate back into cloud re-acceleration. This is the most capital-intensive era in the history of the technology sector. Stay disciplined, stay data-driven, subscribe below for the deep dive. See you at the opening bell.